The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Okay, good afternoon, folks. We are going to take a look at the first chart that I put into Tiger TV today is the long-term weekly chart of the cash S&P market. And as you can see, we are completing this very large pattern that we've been talking about for a long time. We did this on the Dow Jones Industrial Average on the Monday show. And so today I'm going to do the S&P 500 and show you that the pattern is pretty much the same thing. We're looking at going back to 2002 and then where we've gone to where we are right now, including the 2008 move. What's interesting is that I've circled on both of these charts the high of 2007, and then I've also circled what we're looking at now, and these patterns are very, very similar. They're coming together with price and time. Whether they're going to work this time or not, we'll have to wait and see, because maybe it is different this time, but history will tell us for sure whether that's going to be correct or not. The other question that in fact more than one person has asked me by email, why did the market rally in face of the conflict that was going on? Folks, these markets operate, this is my belief, and I've been doing this for a long time, they operate on a force greater than we're exposed to. I believe that these are natural cycles that are out there. I really believe they're astrological. I've never been able to find out why they work, and sometimes they work and sometimes they don't. They're there. We might not see them, but I really believe that's the case. I've seen this happen in my career trading, which spans quite a while. I've seen this happen before, where the news looks like it should be bearish and yet the market will go up, and I've seen it when it should be bullish and the market goes down. That's not unusual. I mean, I'm just watching the patterns, and the pattern completes. It goes down. The Dow and the S&P and the NASDAQ all have stopped over the last month, have stopped right at major support, just like it did yesterday or into Monday. We stopped right at major 61% retracements of the previous 3 days lows, and then the market went up and made new highs. Part of it is when the market doesn't go down on bad news, it only has one way to go, and that's up. And when a market goes when it just does the opposite, when it goes down on good news, it's telling you the same thing, that it's finally over. I've seen this many times, and one of the most I've said this before, but one of the most memorable times was in 1976 when we had the really, really bullish soybean report, and they were called up the limit 4 or 5 days in a row. They ended up opening unchanged and went down the limit for 5 days. So these are the types of moves that happen occasionally in the markets, and they will happen again. The one thing that I feel very strongly about during these time frames that we're looking at now through the rest of the year is that we're going to see increased volatility. It's going to be nothing to see moves of 300, 500, even probably 1,000 points in the Dow Jones Industrial Average. And whether these moves occur or not, we'll have to wait and see. But history says that they will. These markets do not defy gravity. I mean, we've never had one that has defied gravity. There have been several that have tried, and the latest being, Priceline and Google and some of the others, but they do follow Isaac Newton's, second law of motion: for what goes up must come down. So we'll see if this is going to be the case this time. But we'll just have to be patient and wait to see if it's going. We have a little bit of a bifurcated market now, because we've got the Dow Jones is down a little bit today with the S&P up, and the New York Stock Exchange Index is also up. We have an interesting situation, at least so far early today, and that is in the shorter term market in the S&P. We've completed this same 3 drive to a bottom pattern on a hourly chart, and it stopped to the exact 1.27 at least so far today. It's still rather early, of course, but we did make a new high than yesterday by 2 cents from 188 to 188.05, and we'll know whether that means anything over the long haul or not. The Dow is continuing to weaken more than the rest of the market, but remember that is only 30 stocks, so it's not really a fair indicator. I want to take my hat off to Basil Chapman because when he was on Monday and the market was in the sewer, down 220 points, he said right on the air, and I stood up and I saluted him at that time, and he said the market should stop right here and should have a very good rally. And Basil, my hat's off to you, buddy, because it certainly did exactly what you said it would do. So you're a real star here in the TFNN program, so we really salute you. I hope people heard that because it was really a spot-on thing. It was stopping right at a 786 retracement of the previous 3 days low, which was right about to stop it. It was just it was really terrific. He should get a gold star for doing that. And I'm sure if Bud Rolfe was around, he probably also had some spots there to tell you that that's what it was looking at. But these folks have done a great job, telling you what to do. And Basil's kept you guys on the right side of this market for a great deal of the time here. So we are going to have some really interesting markets here with increased volatility up and down. They just don't go straight up, folks. History tells us that that's the case, and the patterns are there. Whether they're going to turn or not, we'll have to see if it's going to be the same this time. I know a lot of you folks keep mentioning the bet that I used to have with Tom O'Brien about riding in his boat about the Treasury bonds. Well, that's past history. We have to go on and see what's going to happen next. Now, there's some rhetoric going on Wall Street about the possibility that Russia will not buy our debt if we put sanctions on them. Well, folks, all this stuff is just rhetoric. If you think that this thing is done in the Ukraine, I think you're being relatively naive. Putin is a master chess player, and as CNN said, that he's playing chess and Obama's playing marbles. So it's going to be interesting what happens. But they're certainly not finished there. They know that we can do very little other than economic sanctions unless we get help from Europe. Europe has a GDP of 10 times what Russia is, so they have the economic power to shut Russia down if they'll do that. But the question is whether they'll do it, and will they take the risk of doing that if they're doing. It's all part of a giant chess game, and that's one of the reasons why you look at charts, folks. If prices are going up, there's more buyers, and if prices are going down, there's more sellers. That's the flat-out bottom line. And this market has not started down as of yet. Once we go below the February 3rd low, which was down around 1750, I believe, in the S&P 500. That's 100 points away, more than 100 points away. Once we do that, then that would be the first indication that we're in for a prolonged bear market that will last, a very, very long time. But until that occurs, I don't think you're going to see much of a major correction here. I mean, you're going to see corrections, of course, but no one will even understand what's going on, and maybe I don't, but this is a really huge pattern that we're looking at in the S&P and the Dow and the NASDAQ. These are patterns that you just don't see very often, and they're so perfectly symmetrical that it's just it's really amazing. One of the questions that I got by email was the Bradley model, and frankly, on the when we made the bottom down around February 3rd, we should have gone up to around the 19th, and we went through that like it didn't even exist. And here we are into the 5th of March, and I don't know if you folks remember this, but this is the anniversary date of the old Toxic Asset Relief Program, TARP. And this is where we are. Secretary of the Treasury at the time, our old former CEO from Goldman Sachs, they had taken their chief competitor, Lehman Brothers, out of the picture, and they were telling us that the banks were too big to fail, that we had to help them or it was going to be the end of the world. And here, there's an old Italian saying is that if you make roast beef and disguise it as tripe, it's still tripe. So anyway, those of you who don't know that tripe is the lining of the stomach, but that was a one of the delicacies that they serve in the restaurants in New York. But at the time when I was a kid, we didn't even touch that. But that was a long time ago. Anyway, this is what we're looking at here: is that you got to be really careful with what people try to tell us, and that's all politicians and economists and stuff. Look at the prices and stuff. If they're going up, they're going to keep, they're higher highs and lower bottoms. Higher highs and higher bottoms, the market's going up. Lower highs, lower bottoms, the market's going down. You look at Apple, you see that it's had a little bit of a rally here of about 13 points, but it's still far lower than it was in November. It's had lower tops all the way down and lower bottoms. This is a stock that is still bearish. It has not come out of the move as much. Now we got other stocks like Tesla and Google that have just gone ballistic, and Tesla is in the news all the time, much like Apple used to be, and that's what the financial press knows what people like to hear, so that's what they put on the show. So don't be surprised, when you're looking at these things. That's the bottom line. We're going to talk about the VIX index at the break because it's still showing that there is absolutely no fear in the market. The other thing that is incredibly negative, and I know history will back me up on this one. I don't know if it'll still be in my lifetime, but when we have margin debt that is higher than it was in 1929, you know that there's a big problem somewhere. But most people, they don't talk about this. It's something that you see it on an occasional website here and there, but frankly, just not talked about. But it really means a lot. This has led to some of the worst bear markets we've had is by people, margining debt and, to buy stock. It looks really just no different than people back in 06 and 07 that were buying houses, 2 and 3 and 4 at a time. I remember there were a couple poker dealers in Las Vegas that owned 5 homes at one time in Las Vegas when the market was going crazy. And on the paper, they were worth a couple of $1 million until the market finally rolled over, and then they lost absolutely everything because they couldn't even sell the houses. So these are the things that you have to remember when you're seeing these things. That this margin is not a good thing. It's a double-edged sword. It's great when it's on your favor, and it's really tough when it's against you. So you have to keep this in mind when you're doing your trading and investing. That don't over-margin yourself. That's one of the worst things you can do in the trade, is to put all your eggs in one basket and then just let the basket run, because you've got to be really careful when you're using margin, because when it goes down, it's really, really bad. This is where I got hurt in 1974. During the October crash of 1974, I learned that lesson badly, and if you don't remember, Newton's Law was good then too. Okay, we got the Dow down about 30, NASDAQ up a little bit, and the S&P up.
If you're new to TFNN, then you've probably heard some of our hosts and traders talk about the exciting charting program, The Art of Timing the Trade Charts. Tuesday, March 11th at 6:30 p.m., Dave White and Tom O'Brien will be hosting a live study session for anyone with a subscription to this exciting charting program. During this hour-long online workshop, Dave and Tom will lead a brief presentation along with taking questions from those that attend. Right now, we have a great deal for all new subscribers. You can sign up for the Art of Timing the Trade Charts and get your first entire month for only $1 while gaining access to this live event with Tom O'Brien and Dave White. For more information on how this exciting charting program works, you can click on the Charts button on the front page of TFNN.com today and check out some of the videos that walk you through a variety of the features included. Sign up now by taking advantage of this exciting offer for just $1 before it's too late. Visit TFNN.com today.
Wouldn't it be great if you could get a red light, green light indicator that gives you signals on 25 different future contracts? Now you can with Taz Signal Box. This red light, green light market profile system dynamically updates 24 hours a day and provides you with important trend and trade signals on 9 different commodities, 9 different indices, and 8 different currencies. Right now, you can receive a free 2-week trial to Taz Signal Box. For all the details and to find out how the signal box works, visit the front page of TFNN.com.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Larry takes your phone calls now, toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks, and I've been asked to post into Tiger TV the long-term Dow chart that is equal to the one that I did for the S&P 500. It basically shows the 60-month cycle that's there. And we are at the anniversary date, of course, of our March 5th low of 2009. I don't know if you folks remember that, but it was they were talking about the end of the world at that time, and it certainly wasn't to be at that particular time. I wanted to share with you one other thing with that chart that we had on the S&P. If you'll just bear with me here and give me just a second to pull it back up. There was something that I remember very vividly because we were watching the Dow Jones trading at 6,400 at the time, and I wanted to be able to show you. I'll do the long-term monthly chart here so you'll be able to, you'll see where we were. And if we have any luck at all, we should be able to get this done here within the next day or so. Give me 1 second to see if we can get this in here. Okay, we're able to look at this here. Oh, shucks, give me a second. It's not doing what I wanted it to do. Don't ever let an Italian try to do two things at once. Okay, let me. Anyway, what I'm trying to show you here. It's going to be a little hard to see, but you have to imagine where we were in 2009 in March, because that low that we were making on March the 5th was an exact 61% retracement of the crash day of October 19th and 20th of 1987. In 1987, the market made a slightly lower low on October the 20th due to margin calls, but they took the margin calls off the book because the Fed basically came in with the plunge protection team and said, you know, the market stops going down here, which in fact it did. What was amazing is the Dow Jones hit the exact 61% retracement from the 87 low also, and it was the 1987 low was an exact 61% retracement of the August 9th, 1982 low. So these numbers that we're looking at certainly have a lot of validity. The question is when they kick in. Right now, these numbers have not kicked in, so that doesn't mean that they're not going to in the future. We'll be able to. The future will tell us whether we're right or not. We'll have to wait and see if that's going to be the case. Now we're going to take a look at the VIX index, because this is the one that's we had a big move up in the VIX on Monday. Given the fact that it looked like we were getting ready to go to a nuclear war with Russia or what it was going to be. That's what they were talking about. And frankly, once you hear the reports and stuff, there's very little that we can do other than economic sanctions. The VIX index then left gap down sharply as with the market took off with the S&P. And the S&P, the cash market, which is the major market, when I posted that, you'll notice that it left a huge gap. It's the largest gap that we've had I think in about 3.5 years, as I recall. And so it's going to be really interesting, because gaps will be filled. If you go back and look at an S&P chart, all the gaps are filled with the exception of one, which was January 17th, 1991, when we had the Desert Storm 24-hour war. But that will also fill that gap eventually, but when and whether it's going to be in our lifetime or not, we'll have to wait and see. But the VIX has gone down to the 786 retracement. It's been here for almost a month now. It's been here 3.5 weeks, so it's there's still absolutely no fear in the market at all. And why should there be? The market goes up. Good news or bad news, the market still goes up. So we'll have to just respect that until we see what's happening. I'm looking at the May 185 S&P puts. They're selling it at what I think is a reasonable price with the market up at this level. You have 2.5 months to work with those, and it looks pretty good. The April would be all right, except they expire on the 17th of April. And we have this huge astrological event coming in on the 21st and 22nd of April, which is, it's going to be, this will be on the newspapers, folks. This will hit all the newspapers and all the TV channels and news programs around the world on the 21st, 22nd. I don't know what it's going to be, but it's either going to be geopolitical, geoeconomic, it could be something just, really, maybe nothing will happen, but it'll be big. I think it's going to be big enough that it'll hit everything. So we'll see. I don't say that very often. When I look at certain things, then I see these things and I go back and look at what history has done, and I get the odds in my favor is what I'm trying to do. Okay, we got the Dow down a little bit. The S&P is basically unchanged.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, folks, I just want to remind you that tomorrow on the commodity show we're having some pretty significant rallies here in corn and wheat, mainly based on supposedly with this Ukrainian situation, but we've got the planting of corn starting here in a couple of weeks, so that'll be interesting. We'll have Rich Anderson on next week. We've got one of our favorite people on the line, John in Philadelphia. John, are you there?
Hey, Larry, thanks for taking the call. I know you're expecting me to call in, or I private message you in the Tiger's Den. By the way, that's the best platform I've ever seen, the Tiger's Den. Thanks to
It is,
Tom
John, no
team.
question about it.
But I wanted to change subjects here. Has nothing to do with stocks. It actually has something important to all of us, namely our food. And the price of cows and pigs, Larry, as you know, is undergoing a skyrocketing phase right here, right now, literally the past 5 weeks. And I have never come across, Larry, in all my days, anybody who does a style of work that you do, wherein you can look for in advance where markets that have gone parabolic have the prospect to turn and peak. And I was wondering if you could apply those skills and techniques of yours to the cattle market right here. The reason being, the cattle market has extended its rally to new highs for the contracts here this morning and made a peak at 10 a.m. And in the past just 120 minutes, the price of cattle futures have reversed down 3% off those peaks?
Well, John, I have looked at cattle, and I know they've been in a parabolic move, much as hogs have. And I don't know where the top is. I just saw it going straight up. I wasn't involved with it because cattle's not one that I follow religiously like I do with the currencies and the bonds and the stock indices. But like all other markets, it has those spots where it goes straight up. Now, I had a projection of 144 in April cattle, and they went a couple cents higher than that, and I know they're below that now. But the fact that it's having a reversal type day today of 400 points certainly means something. The question is whether it'll bounce back from here or it drops straight down. So, that's all I can say. I really don't know. I will look at cattle really closely tonight, and then on the radio show tomorrow for TFNN on the Commodity Hour, I will go into cattle a little bit more. I'll try to get Rich Anderson on the line, too, because Rich is a cattle feeder and rancher, and he probably give us some insight of what things are going. But I know cash cattle have held up incredibly well during this run, and if you start going to restaurants, folks, and you order a 12-ounce sirloin, you're only going to probably be getting 9 ounces because they'll be cutting the sizes back. That's how they compete with the things that they're working with. So just remember that's what probably most happen. John, what's really interesting now is that cattle at this 145 level is almost twice as much as it was in 1978 when the housewives went on strike. You probably don't remember that because you're too young, but the housewives went on strike because the price of cattle was so high, and that was at 78 cents a pound. We're at 140 something now, and of course we had inflation of 14 or 15% back in those days of 78, and it did stop meat consumption for a couple of weeks. But now where we are, no one says anything. They're just accustomed to paying it. So just remember, you're going to start seeing smaller package sizes for your meat. There's no question about that because they can't raise the prices too much. So what they do is they cut back the sizes of the quantity. So start to watch that in the supermarkets.
Larry, I will thank you in advance, and we'll tune in tomorrow on your commodity show to see what your detailed work uncovers. And it's very funny you should happen to mention the 70s. And yes, I was too young. I was a kid. But it's funny. My Wisconsin-based grandmother, who was alive at the time, was a native German. And she always liked cooking beef. And I do remember being at her house somewhere in the late 70s, and remembered her saying couldn't afford steaks anymore, could only serve up bratwurst, which was half pork fat, so it was the cheap cut. Mm-hmm. So believe it or not, I do remember it. Larry, back to the cattle futures. I have to share just a phenomena that I've been observant on the past couple of months. Namely, who's involved in the price of cattle futures and why the price is being driven as high as it is. A month ago, 6 weeks ago, I had looked at the CFTC Commitment of Traders data and noticed that as a group, speculators were heavily long cattle futures. And it is very rare, has been my experience over the past 30 years, in a market where the speculators are positioned very heavily on one side, and the long side in this particular case. Very rare that they actually win. In other words, speculators tend to chase markets into extremes and then get slaughtered. In this particular case, speculators were massively off the charts long 6 weeks ago, meaning that speculators as a group have made just bloody fortunes on this run. And if they're as long as they were then today, I'm just wondering out loud if, in fact, the cattle futures are driven possibly to these highs, not by fundamentals, but kind of by speculative forces. And if that's the case, if, in fact, I'm wondering if the cattle futures market might be set up for kind of situation that you referred to right at the top of your show this morning, the soybean market that peaked and then just went down, 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 just taking everybody apart.
Well, I'll tell you what we'll do, John, is we will try to get Rich Anderson on our show tomorrow. He's traveling around because he stays out of the cold weather, and if we can get him on the program, we'll have him talk about this. But I know that cash cattle are very, very close to where we are, around the $1.45 or $1.45 a pound level. So I know we're not very far away with that. But we'll get Rich on the show tomorrow and see if we can get an answer from him.
Excellent. Larry, that'd be terrific. We'll look forward to that.
Okay, thanks a lot for calling in.
Thank you, Larry.
I appreciate it, John. You bet. Okay, we got a caller from Massachusetts. Are you there, Charlie? What can I do for you?
I'm interested. I'm in already. CLDX. It's a biotech stock.
And what price are you in it?
Oh, I knew you were going to ask the tough question. My
well,
God!
I have to. In order to tell me, I should tell you whether you're long. I guess, right?
Yeah, I'm long. I'm in at what is this? I don't know. I think it's 2608 or something like that.
Okay, so you've got a nice profit in it. Now, if I'm going to post the chart into Tiger TV for you, as you can look at this, this is a weaker than market stock. It topped in September. We had a lower high in just recently when we completed a bearish Gartley pattern back on the 20th of February. It made a 61% retracement of the high from October, and then we had a gap down just a few days ago. So I would be a little scary here. You've got a great place to put your stop. I think you put your stop under Monday's low and not worry about it, because if it's correct, it should hold that level. That was 61% of the move from February 3rd to February 20th. It came down to a perfect 61% retracement there at 26. So, put your stop just right at where you got in, or just a tiny bit below 26. What troublesome here is it is a bearish Gartley pattern, and then you had the gap down on Monday, like the rest of the world, but that is related to emotional things of the Ukraine. But as long as you don't go below 26, I think this stock is still a winner, because you've got higher bottoms. You do have lower tops, but you also have higher bottoms, so you're in the direction of the shorter term trend, and as long as it stays above 26, I think it looks okay.
Okay, great. Thank you.
Okay, thank you for calling in.
Absolutely.
You bet. Appreciate your calling. Some of these stocks that we had such an emotional market on Monday. With the Dow down 250 points and the S&P down 25 and the Nasdaq down, I think it was down 50 or 60 at the time. And then in a matter of a few hours, it took off and went up and made made new highs. And that's just a function of how markets work. The shorts are absolutely scared to death. So every time the market, does start to rally, they remember what happened the day before, the day before that, and so they start to cover, and that's what causes these big moves to the upside. We've seen very little change in open interest in the stock index futures over these last few days, either up or down. So there's very little to help you as far as which direction it really wants to go. So just keeping that in mind. The main thing today to watch from my perspective is the fact that we did make that 1.27 in the cash S&P. We made a higher high than yesterday by 3 cents. Yesterday's high was 188, and I believe the high today was 188.03. And so that's a very marginal high. We made a slightly higher high in the Nasdaq so far. We're still up on the day in the Nasdaq. The S&P is now down just a little bit, but it's still, very, very early in the program for today. And the Dow has only been positive for just a matter of a few minutes early in the morning, and it's been down most of the day. But the Dow is not a very good indicator, because it's basically, just 30 stocks, and they're not cap weighted, they're price weighted, meaning the price of the stock is what gives the weighting on it. It's not how much shares that are outstanding. So that's the main thing. I have a question from one of our listeners about Harry Dent. Harry Dent is an author and frequently on a lot of different talk shows. I'm not sure what his background is. I've met him. I've been on a few shows with him, but I don't remember what his educational background is. But, he's talking about the Dow Jones at 6,000, and certainly that might happen. But, folks, back in the 90s, Harry Dent had a book out where the thing was going to, where the Dow was going to go to 30,000. And so just remember that when, and this goes for me or Basil or anybody else, just because we say something doesn't make sure, doesn't make it real. I mean, you got to go back and look at yourself and do the homework yourself. And like Jim Twentyman says, defy human nature, do the work yourself. I've had a request to take a look at the euro, and what we'll do is we'll look at it on a little bit shorter term basis, because I think we've got the euro getting ready to come down to the 136.75 level. Is that's what my technical analysis looks like. We have this is going over the last week or so. As you can see, we spiked up here on the 20 on that new moon that we had on the 1st of the month. And since that time, we've had a correction. We've been down for 5 days. We've stopped at the 61% retracement, and we still have a possibility of getting down, to the 786 retracement. If we get above the 138.50 level in the euro, I want to put that up and let you folks see this on a weekly basis, because this would be a major breakout, folks. If we get above this 138 level. We need to close like 138.70, up about 150 pips from where it is now, because if we do that, we're going to be breaking out of a long-term weekly downtrend line, a channel line that's been in the euro since 2008. And this market has been bearish since 2008. And every time you sold a rally, all you had to do was to hang on, and you would have been in pretty good place if you would have done that. But right now, it's just sitting there. We could back off a little bit more, and then we'll see what's happening. We have a lot of resistance at that 138.10 level in the euro, but if it goes through that level, then you're looking at something that is a whole different animal, that you'd be looking at, really a possible big breakout in some of these things, and that would make it a lot different from a technical perspective. I really want to show you the gold chart here. We're going to take a look at it on a real short-term basis here. On the gold, because we've had a lot of emotionalism, like we do in everything. Every time there's any types of boots on the ground type scenario, and people rush to gold. They rushed a little bit, but nothing really much happened. But the good, gold's only backed off $20 from the high. We went from we were trading at around 1320 before the conflict, and then we went up and left a gap. We came down and tried to fill that gap. And now we're in the midst of rallying again. We're still only $13 from the high. And if another conflict comes in, we could be looking at much higher prices in gold, which I think we're going to get, because, when we hit that number at 1177 way back in December, that was, screaming buy, because we were at a 61% retracement on the weekly, and that made it, really, really bullish. So we're going to take a little break here, and then we'll be back in a few minutes.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy. A set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days, unconditionally, so there's no risk to you, other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Up next, the Diagnostics Trading Hour with Carol Martin, here on TFNN.
Okay, we're back, folks, and I've posted into Tiger TV the long-term weekly chart on gold. As you can see, that we've made a double bottom down there at the 61% retracement. We've had a very strong rally, $170 an ounce since December, and there's still a possibility that gold could really take off here. There's a slight problem that I see here in the market, and that is not so much in the gold market, but it's in the silver market. I'm going to post into Tiger TV and show you the chart of silver as it relates to the price of gold. The price of gold is in the blue line. Should have probably made that a gold line, but I made it blue. And then you can see the bar chart of silver, and we've had lower tops in silver ever since February 23rd, and the tops are substantially lower, whereas the gold has actually made higher bottoms and higher highs. But there's been no indication from open interest or volume that anything is really happening in either gold or silver. So when they come into these markets, you would think something would be happening. There is a caveat here, and that is that many people, especially large countries and large investors and stuff, they buy the actual cash gold, and they actually take delivery of it, and they put it in their own vaults and stuff like that. So that's also a possibility. And we hear rumors all the time about how much China is buying the gold and stuff like that. But again, that's only rumors. But as far as silver is concerned, it still looks quite bearish. If it ever raises its head and gets above $22 an ounce, I think it has a chance to go a great deal higher. So keep that in mind if we start to look at that. We're going to cover the grains tomorrow extensively because we've had pretty good moves here in corn, wheat, and beans over these past few weeks, which we've been expecting, and we should be coming into an area where they should be running into really strong resistance. And we'll also take a look at the cattle market because we've had a really wild reversal day in the cattle market. Remember, folks, the key thing to watch today is the S&P cash index on the S&P 500. Hit a high of 188.03. If we don't take that high out and close lower, that would be an indication that the anniversary date that we're having here in March, that is just like the one we had on March 5th, 2009. We're 5 years up, 60 months. And the one before that was 60 months, just like we posted when we started the show, both in the S&P and in the Dow Jones Industrial Average. These are really long-term patterns, folks. I've been saying that ever since December 31st, and just the fact that we're above the December 31st high in some of these indices means a great deal, but we haven't really gone a great deal higher than that. So, we're in our longest run without a 10% correction in well over a couple years, and we're going to see one of those eventually, but we'll see. Someone asked a question about how much silver and gold is hedged. There's a great deal of silver and gold is hedged. The gold miners do that a lot. It's part of their charter, and they need to do that so that they can, gauge what their money's going to be coming in. They don't want to fluctuate on the price of gold or silver. There's a few firms that don't hedge, and those are the ones that get whacked the most. For instance, you can see Newmont Mining, what happened to it. And that's one of the reasons why the stock got hit so bad, because the earnings were based on the lowered gold price, whereas other firms hedge it. In other words, they sell gold at when it's up at 1,800 and deliver it later on. And if it's higher, it doesn't make any difference. They've still locked in a price of 1,800. So that's what hedging is all about. If you have any questions about that, we can always ask Rich Anderson when he's a guest on our commodity show. And I'll do my best to have Rich on tomorrow. If we can, and we'll see if he can, give us some enlightenment on cattle, because he is a cattle rancher, and we'll see, how that works out. But keep in mind, your market still looks good, so live every day in an attitude of gratitude, and may God bless.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.